Hello, investors. Good morning, good afternoon, or good evening, depending on where you're watching me from. My name's Joseph Areo, here once again to talk to you about investing in securities, investing in passive assets as a good way of helping you to grow your assets, to grow your wealth, and more importantly, or most importantly, to become financially independent. We have talked a lot about fixed income in the past. In particular, we talked about bonds. Today, I want to talk a little more about bonds again, if only because bonds have been in the market, or rather in the spotlight around the world lately as interest rates rise. Some companies, banks have been collapsing, partly, if not to a large extent, because of that. So I want to speak to you again today to help us appreciate some important facts or issues about bonds. So firstly, in this episode, I want us to talk about bond pricing. I did speak about it before, but I would like us to talk about it again in the context of what has been going on, interest rates going up, and things like that. So, what is the price of a bond? What does it mean when we talk about pricing a bond? So remember, a bond is basically a promissory note. So it's a contract that entitles you, the buyer, to a certain payment in future, what we call the face value. And depending on the type of bond you're buying, several 6-monthly or what we call coupons every 6 months before maturity. That essentially is what the contract called a bond is. So when you're buying a bond, you are buying basically two rights. You're buying one, the right to be paid a certain amount of money at maturity, meaning at the end of that contract. That could be whatever, 10 years, 5 years. At maturity, you're buying the right to be paid a certain amount of money called face value. And secondly, depending on the bond, you are also buying a right to be paid every 6 months what we call a coupon. Some people loosely call it interest, but the proper term for it is a coupon every 6 months, which is a percentage of the face value. So when you're buying those two rights. When you're selling your bond, you are giving up, you are selling those same two rights. Now you are giving them up to someone else to enjoy. So when we talk about the price of a bond, when you're buying, the price of a bond is or determines how much you should pay today when you're buying in order to enjoy those two rights I talked about. One, in order to enjoy or be paid a certain face value, a certain amount of money at maturity, and two, in order to be paid a coupon every 6 months. So how much you pay today essentially is the price. If you're selling the bond, it's the same, except now it is how much you want to be paid today in order to give up those two rights. Okay? in order to transfer those two rights to whoever is buying the bond from you. Right? So that essentially is what the price of a bond means. In terms of expression, the way it is, nomenclature, in terms of the way it is expressed, the price of a bond is always quoted per 100. So in our region, you can say per 100 shillings. Okay? So if you're buying a bond, so for instance, you want to buy a bond which should pay you 10 million shillings 5 years from today. Okay? And every 6 months, a certain coupon at a certain rate. You will be quoted a price per 100 shillings of the face value. Right? So, face value is 10 million shillings. How much do you pay today for every 100 shillings? It's another way of saying what percentage of that face value do you pay today in order to enjoy that face value, to be paid that face value, and to be paid the accompanying coupons every 6 months. So you will see a price being quoted at 100, meaning you pay 100%. 110, you pay 110%. 90, that means you pay 90%. So if the face value is 10 million and it's priced at 100, so you pay 10 million today to receive the face value plus the coupons. If the price is 90, then it means you pay 9 million today in order to receive 10 million at maturity, in addition to the coupons every 6 months. If you're selling that bond at 10 million face value bond due at a maturity of 5 years, well, if you sell at par, it means someone is going to pay you 10 million today for you to give up those two rights to him or her. If you're selling, say at a price of 90, well, then you want someone to give you 9 million today, and you give up those rights and they enjoy it, and so on and so forth. So prices of bonds can then be categorized into 3. So firstly, you have bonds which are priced at par. So you've just heard me saying maybe a bond is priced at 100, meaning that you pay the full amount of the face value, 100% of the face value today, in order to enjoy or to receive that face value plus the coupons. So that is called par, P-A-R. Whenever you hear, oh, this bond is priced at par, that's what it means. And I want to emphasize this because there is always a lot of confusion in the public when trying to buy bonds. They expect all bonds to be priced at par. So they think, if I'm going to get a face value of 10 million, then I should pay 10 million today. Not necessarily. But if it is priced at par, yes. The second category of pricing, it would be what we call a discount. A bond could be priced at a discount, meaning the price will be less than the face value. Right? So you are paying today less than what you will be paid at maturity by whatever amount as determined by the market. So if a bond is priced at 90, then it means you're basically paying 90 out of every 100, or 90% of the face value today. The bond is priced at 70, it means you're paying 70% today. So what would determine the discount? Well, several factors could determine that. One, the market demand, basically. If the demand is not so high, well, then the price is going to come down, isn't it? That means the bond will sell at a discount. So, in summary, what are the determinants of the market price? One, I talked about inflation. When inflation goes up, we've been living in a rather inflationary environment lately, since the days of COVID. So when inflation is trending upwards, prices of bonds tend to trend downwards. Investors would want a bond, when they're trying to buy a bond, they want it at a discount because inflation is going up, and therefore the purchasing power of their money is likely to be affected. They are locking up their money at a certain value today, but over time that value is likely to come down because of inflation. They would want, therefore, to be compensated, and the way they do that is by asking for a lower price, a discount. If inflation is coming down, on the other hand, then the prices of bonds is likely to go up. The second determinant of prices could be interest rates. When interest rates are going up, then the price of a bond is likely to come down. Not likely, it will come down. In other words, the bonds will sell at a discount. But if interest rates are trending downwards, then bonds sell at a premium. So again, we have been living in a rather inflationary, what we call expansion, an environment where interest rates have been trending upwards, what in economics we call a tightening environment. So interest rates have been going up, and that means many bonds would be priced at a discount. Okay? And a major reason that interest rates go up, at least two main reasons, is one, again, I said earlier, inflation. When inflation goes up, well, one of the things which tends to go up is interest rates. But generally, interest rates would be determined by policy, what we call monetary policy. Central banks determine the rates, and they determine when rates should go up or when rates should come down. In our region, we talk about central bank rates. Those are some of the determinants of interest rates, and those eventually determine the price of bonds. Okay, so those are the categories of bond prices: 1, par; 2, discount; and 3, premium. And that essentially is what the price of a bond would mean. So I hope that this clarifies, you're clear in your mind. When you're buying bonds, you know what to expect, and you know what it means when they tell you, oh, the bond is selling at par, it's selling at a discount, or it's selling at a premium. Thank you very much. Do subscribe to my channel so you get notifications for further posts of videos on this interesting subject of investment. Thank you. And next time, I'm going to talk about the risks, some of the risks of investing in bonds, in particular, given the environment in which we live. We live in an environment where interest rates have been going up, inflation has been going up, stabilizing a bit now, But in that kind of context, I want to discuss with you in my next episode what risks you should watch out for when you're buying bonds. Thank you for watching.